My name is Richard Claywell. This is Litigation Speaks. What I'm doing is putting on a series of YouTubes and podcasts to explain to attorneys how, when a business valuation is performed, it's things that you should be looking for to make sure that your expert and or the opposing expert has handled the situation in a correct manner. Typically, when you see a webinar on doing business valuations or some sort of training on business valuations, it is always, here's how you do this. But what they don't tell you is, here's how we mess it up. So that's what I want to talk to you about. Today I want to talk about not normalizing operating expenses. When we do evaluation, there's a process that's called normalizing. We want to look at the financial statements, and we need to normalize both the balance sheet and the income statement. And what I want to talk about today is the income statement. When we normalize that, what we're looking for are non-recurring types of items, one-time events, items that may not be at fair market value, and we'll talk about these in a minute, but that's what we're looking for. We need to adjust the financial statements to GAAP, generally accepted accounting principles. Now the literature says financial statements. That's plural, which means the balance sheet and the income statement. What we want to do is convert the financial statements to generally accepted accounting principles, and it's typically called GAAP, G-A-A-P. We want to look for discontinued operations. We want to look for discretionary items. Those are the types of things that we need to find, and we want to adjust for those. In a deposition not too awfully long ago, about a year or so ago, the opposing expert did very, very few normalizing entries, and I had quite a few. In his deposition, he was asked about that. He said, well, it's not material, it's only a couple $1,000s. So I've got a little chart that I want to show you where the not material couple $1,000s can add up very, very quickly. We want to adjust officers' compensation. Now the officers' compensation, a lot of people have trouble understanding that. I personally don't care what your compensation is. That's not my issue. My issue is, if I'm going to buy your company and I'm going to replace the management, what is that replacement management worth? And that's what we have to try to determine. In this particular deposition, the other experts said that management thought that these people should be getting X number of dollars, and they just left it alone. That's not the way it's done. You need to go out and look at databases and find supporting documentation for what a reasonable compensation would be for a particular type of executive that you might have, or their family members, where you're paying them a lot of money to do whatever. I actually had a case probably 15, 20 years ago. The man died, the father died, the son was now running the company. The mother was working for them, which is absolutely fine, and she was paid $70,000 a year. Her only task was to go by the post office and pick up the mail in the morning, and she got $70,000 a year to do that. If I'm going to buy the company, I'm not going to pay his mother $70,000 a year just to go to the post office. So that sort of thing needs to be normalized. When you adjust for that, you need to also adjust for the payroll taxes that go along with that. We're looking for non-recurring items. We may have some lawsuits, some uninsured events. The list can go on and on and on. We need to identify those and remove those from the earnings that we have within the financial statements. We also need to look at expensing items versus capitalizing items. The U.S. tax code allows us to deduct items. It's under Section 179. Again, I do not have a problem with that. That's what the tax code says, but that needs to be adjusted in order to determine the fair market value of the company. What we're looking for is, what are the future operating income going to be for this particular company? So we have to normalize or adjust for this to make it a really true fair market value. The things we want to do is look at the assets that are acquired. The Internal Revenue Service allows us to expense items, and it's Code Section 179, but that's not an ongoing event. We're looking for the matching concept, which says we have depreciation, we have to match that depreciation with the future events of the particular company. I've prepared a little chart And what I'm showing is, here's what the income would be, or the cash flows would be, if we did not normalize anything, i.e. it's only a couple $1,000 versus normalizing for specific items. When you do fair market value, it's a hypothetical buyer and seller. So think of this. If you've got either control or minority interest, the company's going to be sold. If I'm a minority shareholder, I'm going to get my pro rata share of whatever this sells for. So the more items that you say are immaterial, I'm just not going to do anything with them, reduces the value of the company, which is going to reduce the sales price. And so is the controlling shareholder going to do that, or the minority shareholders are going to allow for that to happen? There are questions that I prepared for the attorney to help block in a particular expert. I'm giving you what the question might be and what the answer might be. We are also going to provide a blog, which I'm going to go into more detail on how to handle these specific issues. And we're in the process of putting those together for you right now. And I appreciate your time. If I can help you with any of this information, feel free to either give me a call or send me an email. Thank you.